most of the quote unquote influencers, they kind of give you that vibe and feeling that you can't make loss with mutual funds.
It is not true. Any ticket size gets fit into mutual funds. So there is no fixed minimum contribution that you need to make. You can invest as low as 500 rupees, and you can invest probably 50 lakhs or 5 crores or 50 crores as well. One is the tenure, one is the risk that you are ready to accept. And then probably you need to determine.
Can you give one or two action steps that my audience can take in, let's say, next 24 hours that will help them to get started with mutual funds? If somebody who is just starting out, they are new into mutual fund investing, what are some of the mistakes that they should avoid?
So they rely solely on past performance. That is the number one mistake, and they should avoid it. Second thing, maybe underplaying their risk capacity. Third thing is.
Hi Tejas, welcome to Decode Mastery Show.
Hi, Srinivas.
Hi. In this episode, we talk to experts and we try to take one topic that is relevant to business owners and people in large, and break down the topic into a step-by-step action plan so that my viewers can watch the episode, and by the end of the episode, they have a clear action plan that they can implement it right away. And I think we know each other from last, I don't know, like how many years now. It has been like last decade or something.
At least 14, 15 years.
At least 14, 15 years. Both of us met in college, and you are an expert in financial services, mutual funds. So I thought talking to you about mutual funds and help my viewers to understand what exactly they are, and let's get started with the mutual funds. Somebody who has no idea what mutual funds are, because everyone is talking about mutual funds these days, thanks to the crazy race in stock market. Yeah, so that's the core agenda for today. So before I ask you questions about mutual funds, if someone comes to you and asks you like, what do you do? How do you answer them?
So basically, I help people build wealth so that they have money that can fulfill their goals and desires.
Okay, and you do it by?
So we help them invest in various mutual funds, stocks, bonds, depending on their individual needs, and we help them monitor their portfolio. We help them have a diversified portfolio, and in a way, first we help them create wealth, and then we help them preserve wealth.
Nice. Now let's say if someone has, let's say, 1 lakh rupees,
Hmm.
and they come to you and ask you, where can I invest? Can you just list down like what are the top or the possible investment vehicles that they can invest in?
So most common vehicle is fixed deposit. You go to a bank, you put a fixed deposit, bank pays you fixed interest rate, per month, per annum. Other options are private bonds, wherein you invest in a particular bonds or debentures, and again they pay you a similar interest rate, a bit higher. Then there are PPF as an investment option, which is provided by government. Uh, Apart from that, you can directly invest in stocks. You invest in companies that you like. Then there is mutual fund. Basically, that is an investment vehicle that indirectly invests in stocks and bonds. So that's basically a professionally managed investment vehicle. So that is one. Then there are a bit exotic products such as portfolio management service, alternative investments. So yeah, those are the options that we have.
Perfect, makes sense. So let's get started with the basics of mutual funds. If
Hmm.
you have to explain what mutual funds are to a layperson, let's say a 15-year-old kid, how do you explain it to them?
Okay. So mutual fund is basically professionally managed funds wherein they take money from you. They identify companies that could grow over a period of next 3 to 5 years, and then they deploy all these collected funds into those securities, and they periodically monitor it that how they are performing. And as and when those companies grow, your value of your mutual funds grow, and in turn you get your returns. So basically, that's a professionally managed funds wherein you get the benefit of those growing companies by investing in a mutual fund.
Okay, so you give the money to an expert, and then they invest it for on behalf of you, and they give you the returns.
Yes, yes.
Okay, and where do these guys invest the money? Are these the same vehicles that we talked about some time back?
Yeah, so typically you invest in stocks of a company, or it could be bonds or other securities. So mutual funds basically have equities, stock, equities, bonds, NCDs, gold, and now the recent option is REIT, which is REIT and Inward. So those are the options that mutual funds invest in. Now each have a different flavor and different performance. So stocks basically grow with the performance of a company. Bonds is basically gives you a fixed return, but again protects the capital. REIT is where it's a yield generating asset which is pulled together, and that gives you like a coupon and a bit higher yield than your normal bonds and NCDs. And there are some options such as gold and silver, wherein you can invest in paper gold and silver.
Okay, so this professional can invest anywhere and everywhere. Is that what you're saying?
Yes,
Okay,
not in real estate, but all the financial assets.
all the financial assets. Okay, makes sense. And are there any different types of mutual funds, or like all of them are same?
So primarily there are equity and debt mutual funds. Equities typically invest in stocks of a company. Debt mutual funds basically invest in fixed income securities. And then there are a lot of hybrid schemes wherein it's a combination of debt, equity. There is also an element of commodities in play. So typically it's equity mutual funds, debt mutual funds, hybrid mutual funds, and then there are various subcategories based on their end use.
Okay, so now if someone wants to get started, which type of mutual fund would you recommend?
So generally, if in today's time, if a person is starting and has a horizon of say more than 5 years, we generally recommend them go with something which is diversified equity funds in the market to get exposure to all size of companies, whether it is small, whether it is large, you get all kinds of exposure. And once you spend a good number of years in the market, then actually you should start looking at diversifying into various particular segments or particular kind of schemes.
Okay, no, so let's break it down. Okay, if someone is just say 21, 22 years old, just got
Mm,
a job, first salary, and
mm,
he's let's say he's getting around let's say 35,000 per month salary.
mm.
What do you recommend to him?
So typically, when a young person comes to us for investing, their main goal is for wealth creation. So when you're looking to create wealth, you need to invest in the equities. But again, the first question that we ask them is how long you are willing to keep these investments. So if they have a period of say more than 5 years, then equity would make a lot of sense for them. So if a person comes to us and say I have 5 year period, uh, so equity mutual funds is one option. Now in that particular bucket, there are a lot of schemes. Now based on the individual discussion, what is the risk appetite, what is uh, their expectation about investment returns, we can give some options that they can look at.
Okay, so if someone is starting new, you recommend equity. And
Mm.
let's say if someone is let's say 30, 35 years old, making around let's say 15 to 20 lakhs per annum salary. Now what do you recommend him?
Again, see, everything depends on the goal of an individual. First, they need to be very clear whether they are in the bucket of wealth creation or wealth preservation, right? In wealth creation, you want your wealth to grow as quickly as possible. So for that, you need to be in equity. If you are in the stage where you have already built some wealth and you want to preserve it, so by preservation, you want to earn a bit more than what the inflation is, right? Then there are a lot of hybrid funds, a lot of multi-asset funds which are available, so that you can look to invest, and then you can preserve your wealth at the same time grow it at a decent pace.
Okay, makes sense. Now we talked about equity right now. We everyone knows the risk of stock market, right? Sometimes it can go up, sometimes it can go down. Is it the
Mm.
same with mutual funds as well?
It is same in a way that the mutual funds are volatile. So you would have read disclaimer at the end of any ads. Mutual funds are subject to market risk. So market risk basically means that there will be lots of ups and downs. So you need to be able to accept that volatility in your portfolio. However, why that volatility comes because businesses are always cyclical. So some businesses do very well in certain periods, some businesses don't do well in that period, right? So you want to be invested in the companies that are likely to grow, but you also have to grow with the company during those cycles. And that is why even market has a lot of cycles wherein it goes up in a certain fashion, then pulls back, and then again it goes back. So markets are volatile, and there will be inherent, upside and downside. But the most important part is you ride it through all these cycles.
Okay, so because most of the quote unquote influencers, they
Mm.
kind of give you that vibe and feeling that mutual funds, you can't make loss with mutual funds.
Uh, it is not true. So in last 4 year market has gone in a way that everyone has seen the upside. So all those investors who have particularly come in last 4 years, they have only seen the upside because market has behaved in a way that it has grown almost three and a half times, right? But if you look at a decade prior to that, from say 2010 to 2020, there were lots of cycles in between. So we had 2012 where there was a currency crisis. Then we rode Modi wave. Then again there was a slowdown in 2016. Then again there was some upside, from 2016 to 2018. Then we see again a downfall from 2018 to 20. Then we saw the COVID. So market would always go through certain cycles. Yes, so it is not that you won't make a loss, but yes, if businesses are doing well over a long period of time, they are likely to grow. So that is why in mutual funds, the longer you go for your investment time horizon, you are likely to make more money.
Okay, so then theoretically, let's say if a person can invest 1 lakh rupees, and if the
Hmm.
markets are bad, he can lose the entire money, right?
Uh, Again, not the entire money because see, ultimately, as a fund manager, they are going through the companies, understanding the businesses, how they are performing, and what sort of returns those companies are expecting, and what sort of risk they have on their businesses. So it is very unlikely that your mutual funds will go to zero. But yes, there would be a typical downward cycle wherein you could have a downfall between say 10% to 30% as well during particular say 6 to 8 months or even 12 to 24 months. There could be certain period wherein you get a negative return of 10 to 30%.
Okay. And so basically, you said equity mutual fund, equity type, and debt type, right? Equity is where the fund manager invests in the stock market, the shares of the company, and
Hmm.
debt. And where do the debt funds gets invested?
So debt funds invest in government securities, government bonds. They invest in treasury bills. They invest in corporate credit market, like they lend it to corporates. There would be certain structured products wherein if they are lending to corporates, they will structure the deal in such a way that they get a bit higher than what the bank makes on the loan. So
Okay.
there are various ways in which a mutual fund also lends to corporate. So there are liquid funds, there are low duration funds, there are corporate bond funds, there are credit risk fund. So depending on various objectives, whether you are lending for a short period of time or a little longer period of time, whether you are looking to say take a credit risk or a time duration risk, so there are a lot of securities where you can invest and get returns from the debt market as well.
Okay. So if let's say if someone, the whole objective is to preserve their wealth, that they don't
Hmm.
care about the wealth growth, then would
Hmm.
you recommend debt mutual funds or FDs or mix of both?
So ideally, when you're looking at preserving wealth, fixed deposit always, gives you fixed coupon rate. So ideally, you take out the volatility from the portfolio. Again, then you have a corporate risk that wherever you put in fixed deposit, whether that bank or a financial institution goes bust or not. Fortunately, in India, RBI has made a strong provision for banks wherein it is very unlikely that a good nationalized banks would go bust. So that is one option. Um, if you want to play it very, very safe, fixed deposit are the best option. For ultra high net worth individuals, debt funds provide better cushion because that diversifies their risk. So at each point of time, that debt security, debt mutual fund would have exposure to at least 20 to 50 different types of companies and securities. So that in essence diversifies the risk for them. And that on the taxation part, both are equal now. So whether you invest in debt or whether you invest in fixed deposit, taxation way both are same. Only difference is that on fixed deposit, even if you do not get interest, so you get a cumulative interest, then also you have to pay income tax every year based on the accrued interest. Whereas in debt mutual fund, you only have to pay tax only when you redeem the funds.
Okay, makes sense. So just to summarize what we discussed, let's say you have a money want to invest in, you can either invest yourself or you can ask get the professional to do it for you. If you do it for you, you basically pay a mutual fund company and the fund manager takes that money and they invest the money on your behalf, and they can invest either in equity fund or the debt, primarily these two, equity type or a debt type. So this is what people call it as actively managed funds, right? And what is the difference between a now an actively managed fund and a passively managed fund?
So active management is where fund manager has to take a call that where should I invest, whether I want to give money to X company or a Y company, and what proportion I want to give. Whereas in passive mutual fund, it is more of a defined way, model based, or it would be a benchmark based, wherein already everything is defined and you just invest money in that fashion. Say for so it has a composition which is fixed for all the securities. So say Reliance would have 10% weightage, HDFC Bank would have maybe 8% weightage. So everything is defined. So whatever money comes in that index fund, it would go in the same bracket. Same basically wherein the fund manager do not have any role. It is just that they have to invest in that fixed proportion.
If the fund manager takes your money and he actively invests you, it's called as an active management fund, right? So basically he
Hmm.
makes the decisions on your behalf.
Hmm.
And there are also something called as passive funds where technically the fund manager doesn't do much of thinking, he just follows the
So
set.
there is a set benchmark and set model wherein your money goes in the certain way.
Okay, so now there are like three types of companies, right? Large cap companies, mid cap companies, and small cap companies. Can you just give a overview of what they are?
So basically, large cap company means the company which has grown very, very large over a period of time. So most of the companies that we see, in the locality, say for example, SBI or HDFC Bank or Reliance, those company or L&T for that matter, all those companies have grown very, very big over our decades, in last 3, 4 decades. So those are basically having a large market capitalization. That's why that's called large cap. Then there are those companies which are not as large as Reliance or HDFC Bank, but are decently well known and have been market leader in their respective segments. So, say for example, Bata. So Bata is not as large as say HDFC Bank, but it is still a very big name in its own space. So that comes under say mid cap. And there are companies which are not large cap, not mid cap. So those are the smaller companies which are yet to make the name. There could be companies which are very much known in their segment, but that segment is still growing. or those are the companies which are, say, smaller size companies wherein their turnover could be in the range of, say, 500 crores to say 3 4 thousand crores.
So now, are there any different types of passive funds, or we call it as an index funds, right? Are there any different types of index funds?
So there are a lot of indexes which has been defined. Say for example, Nifty 50 is one, Nifty Next 50 is one. Then there is a mid cap index. Then there is say high momentum funds. So basically, a lot of ways in which the benchmark has been created, and for that, respective mutual funds are also there. So each follows their defined strategies, and they invest the money there.
So if someone wants to get started, would you recommend an active fund or a passive fund?
So basically, India is the land of opportunities, right? Still, we have a lot of scope wherein fund manager plays a role in identifying a company and seeing it grow over a period of decades. Last 4 years, where entire market has rallied, so index funds have done phenomenally well. But again, there could be some time wherein indexes might not grow. So all companies do not grow, but wherein selective pockets would do very well. So then the active fund management role comes in play, wherein fund manager is able to pick out those companies that could do very well. Again, both have their benefits and disadvantages. So, for example, you are looking to invest in passive funds wherein fund manager do not have a role. So, if market is doing extremely well, passive funds also do very well. So at that time active funds might find it difficult to catch up, whereas if indexes are not growing, entire market is not growing at that faster pace, but individual segment or sectors are doing very well, so maybe at those time active funds could do much better.
Okay.
So in India, because it is a land of opportunities and a lot of companies are growing, India is a 140 crore population consuming each and every day. So there are a lot of scope for individual fund manager to pick and choose that what companies may grow over a period of decades.
Okay, makes sense. So again, there's no one fixed solution. Go here or go
Yes.
there. Okay. And we have actually talked about the risks of mutual funds, right? You can if it is in the equity, it can you can get significant losses. Now let's talk about some of the benefits now. So again, as a layman, what do you see? Like, what are the benefits of investing in a mutual fund?
So most important benefit is you know any ticket size gets fit into mutual funds. So there is no fixed minimum contribution that you need to make. You can invest as low as 500 rupees, and you can as invest probably 50 lakhs or 5 crores or 50 crores as well. So there is no limit that you can put on the mutual funds. So it is basically all size of investors can invest. Again, you can withdraw any amount that you require from the fund value that you have. So, for example, say for example, you have a real estate, right? You have a home, and probably that is worth 2 crore. But now you are in need of say 25 lakhs. So you are not going to sell one bedroom and just take out 25 lakhs, right? Whereas in mutual fund, you have a portfolio size of 2 crore and you want to withdraw say 20 25 lakhs, you can very well do that. So that gives you a lot of liquidity options with you. So that is a very good benefit that you enjoy. The second advantage is the professionally managed returns that you get. So when you know that there is somebody who is interested with your money, and they are basically researching on the companies day in day out, and your investment is spread across 50 60 different companies, right? So you can be rest assured that over a period of time you are going to generate a decent return, because you are indirectly putting your money on the management of those companies, that they are going to do very well. So
Okay.
that way they give you a good return. And third big advantage of mutual fund vis-a-vis stock is that in stock you need to put in a lot of time, and when you say realize a profit, you need to pay a short-term capital gain tax or a long-term capital gain tax. Now you need to redeploy that funds, right, to grow again. So again, when you sell those particular stocks, you need to pay the taxes again. So at each churn, you need to pay the tax when you manage it yourself. Wherein in mutual funds, fund managers do that churn, but you have to pay tax only when you finally redeem your funds. So, for example, you have put in your funds for 5 years, right? During those 5 years, fund manager might have changed 5 times the portfolio, but you do not need to pay taxes during those 5 years. You have to pay taxes only when you redeem at the end of 5 years.
Okay, makes
So
sense.
that actually helps you, compound your wealth at a better rate than the stocks.
Okay, then just to summarize some of the key benefits, someone can get started with the smallest of the smallest amount to the biggest of the biggest amount, and then he can withdraw or redeem a partial amount. He need not withdraw the complete amount, and there are
Mm.
like few tax benefits as well for the mutual funds.
Right.
Okay, makes sense. So now let's say if someone is just again starting into mutual funds, you said he can start with a small amount. Now let's say someone wants to start, let's say with 500 bucks.
Mm.
How soon he can get started? Like let's say if I give you the money or to the fund manager, by when the account, how much time it will take for him to get open the account and get those funds investments?
So with digital initiatives, it has become very very fast. So first step is to get your KYC done.
Mhm.
So KYC probably can be done in one day, wherein you do it online with other linked DigiLocker, or maybe you fill up a form and submit it to the respective KRA, and the KYC is done in 1 to 2 days. Thereafter, you can start investing with various companies, various mutual funds. Again, a lot of procedures are now online. So if you have, say, for example, your PAN card, Aadhaar card handy with you, you have done your KYCs, then you can just start filling in the details, and you can get the investment done right there and there. So the time is now, probably you can do it in a day as well if your KYC is there. If your KYC is not there, probably 2 to 3 days.
Okay, that's reasonably fast.
Yes.
Okay, now like again, how does someone again has let's say 1 lakh rupees?
Mm.
He's just starting to invest in a mutual fund. What are the
Mm.
factors that he should keep in mind before he selects a fund?
So most important thing for him to would be to determine how long they're willing to keep the funds. So if you have a time horizon of say 5 years and more, probably one kind of funds would be suitable. If they have a shorter time frame, say for example 1 year or 2 years, a different kind of funds would be better for them. The other thing would be risk appetite. So how much negative returns they are able to see in say 1 year period or 2 year period, because if they are fine with seeing their portfolio down by say 30-35% in maybe 2 years, then probably they are more of aggressive investors. If they are more of defensive investors where they do not like to see their portfolio negative, then there would be something a safer investment schemes would be for applicable for them. So, one is the tenure, one is the risk that you are ready to accept. And then probably you need to determine that what return do you expect from the market. So, whether you want to be in the companies that are aggressive, or whether you want to be in the companies which are, having more margin of safety, or maybe, they are growing at a decent pace, but again, not very, very having, bold targets. So, I think these three factors would help you determine which schemes could do well.
Okay, tenure, risk, and what was the final one you said?
The
Return expectation.
final return expectation.
Okay, makes sense. Now let's say if someone has decided, you know what, this is the tenure that I want to invest in. This is my risk appetite, and this is the return that I'm expecting in. And he wants to get started with the mutual fund, investing in the mutual fund.
Mm.
What are the steps now that he need to take now to get started now?
So there are a lot of online tools which are available. You can go and look at various schemes that are available there. So as you mentioned that large cap, mid cap, small cap, those are one type of funds. Then there would be say multiple multi asset funds. There could be say uh, maybe combination of debt and equity funds, which is called balance advantage fund. So that is again hybrid funds. So a lot of funds are there. So there would be more than say 1,500 or 2,000 mutual fund schemes. So you need to determine that what sort of schemes you want to get into. Then you need to look at the rolling return of those funds. So basically, most of the people, tend to look at the past performance. That okay, these funds have done very well. So you look at the best schemes of last say 1 year.
Hmm.
Now that return is already in the past. That may or may not be repeated in the future, right? Because one kind of strategy has worked in the past, but that strategy may or may not repeat the same performance in say next 1 to 2 years or 5 years. So you need to be realistic that what are your return expectation. If say your return expectations are between 15 to 20%, you can be rest assured that the schemes that you identify, so it may not be the top performer for this particular year, but they may still do well over a period of next 3 to 5 years.
Okay. Now, like if he wants to like actually invest the money, is there any website that he needs to visit, or d- does he need to talk to someone, or like what's the procedure there?
So for example, if you are do-it-yourself investor, wherein you have a good financial acumen, you know about your risk appetite, you know how to, find out the schemes that you want to invest in. There are a lot of direct platforms that are available. Say, for example, ET Money is one, Zerodha has one platform called Coin, Grow has one platform. So those are the direct platforms wherein you just go there, you select particular schemes to invest, and you just get started. uh, if you want somebody to handhold you during that investment journey, and you want to talk to somebody that okay how my funds are performing, whether any changes are required, or probably you want to understand more about mutual fund, how it works, you want a constant guidance,
Hmm.
then probably you go through a say RIA, which is investment advisor, or a mutual fund distributor. They will be able to explain you nuances of mutual funds. So, wherein if you do not want to invest that time to research everything by yourself, you always go through somebody who spends a lot of time, doing that.
Okay. Now, what's the cost and benefit of going through a, let's say, a RIA?
Okay, so RIA basically helps you invest in direct funds, direct schemes, wherein there is no commission involved for the RIA. So, whatever remuneration he seeks it from you, right? So, he will charge you certain fees, and then they help you invest in particular mutual funds. And then they will review it over a period of time, and if there are any changes they can recommend you the changes, right? Wherein if you invest through mutual fund distributor, they cannot charge you anything separately, but they will get the commission from the mutual fund company itself. So in both ways the person needs to be remunerated for the services. So in RIA, he charges you separately and provides you the service, wherein mutual fund distributor basically helps you invest but gets the commission from the mutual fund companies.
So now the investor has three approaches or three ways that he can look at, right? One, he can directly invest himself, do the research, and invest through an app on, let's say, like Zerodha or Grow or ET Money or something like that. That's one option. The second option is through go through a RIA. What's the full form of that?
It's a registered investment advisor.
Registered investor, registered investment advisor, where he charges a fixed amount, and then he gives you advice on where to invest and where not to invest, and he will not take any commission on your investments.
Mm.
Then the third option is the mutual fund distributor, where he kind of advises you and then he helps you to invest, but he takes a commission directly from the mutual fund company, not from you.
Correct.
Out of the three, like what's the better option? Like which approach should someone start with?
So help would be better for you when you are just starting, because I believe you may not have that time and financial acumen of investing. So that is why if you seek a help of say RIA or mutual fund distributor, that would be helpful in the initial stages. Maybe after years and years of experience, you could go direct if you wish to. But again, in our experience, basically we are a mutual fund distributor, and we have seen that people want to interest or maybe seek a help of somebody when they want to decide about their funds, because a mutual fund distributor or a RIA spends a good number of years in the market. They constantly, discuss with various fund managers about how the market is moving. They understand that okay, market may not go down forever, may not go up forever. So they help you make a balanced decision. So they help you not get carried away with the flow of money or flow of market. They keeps you anchored. At the same time, they help you navigate the various volatility in the market.
Okay. Taking a help from a professional is always better option.
Yes.
Then I agree with that. Yeah. And based on your experience, like how much money someone should start their SIP or investments with?
So if you're just starting and say if you have a responsibility on you about your family and provide for your family, then you always want to start with something which is available easily with you. So whatever amount that you can save per month, you can start with the smallest amount possible. However, if you do not have the responsibility and you have the funds with you, then at least 10 to 20% you could start with your for your monthly salary, and then probably you spend a year or two in the market. You see how funds are performing, how market moves. You also research about the companies, and you also research about the economy, how it is performing, and then you should try and gradually scale it up over a period of time. Because what we have seen is that when you invest aggressively in the initial years of your earning journey, a lot of comfort you get when you turn say 35 to 40,
Uh,
because by that time you would have made a decent wealth for yourself and your family. So you have a lot of appetite to grow your wealth. At the same time, you could either invest in property, or you could make a good decision for your family. So typically, when a young person comes to us and say, for example, a lot of times they have the question whether I should invest in market, through mutual funds, or whether I should say buy a property. Now, I'll just give you an example that if you're buying a property, say worth rupees crore. So generally, what they do is they accumulate say 5-10 lakh rupees or 20 lakh rupees. They put them as a down payment and they take a loan and they buy a home. Correct?
Correct.
Now, what happens is that whenever you take an 80 lakh rupees loan, there would be an EMI of about 80,000 rupees per month, right? So that you are constantly paying EMI and the interest to the bank. So that caps your ability to invest that money somewhere else. Now, for example, you are for 5 years paying 80,000 rupees EMI. So that roughly is what? About 10 lakh and 50 lakh rupees is what you pay in the 5 year period. Roughly about that. Okay. Now, against that, if you invest in mutual funds at the same amount, 80,000 rupees is what you invest, in mutual funds. You actually invest that 50 lakh rupees, but that over a period of time could grow to somewhere between 70, 80 lakh rupees. So, in a way, over a period of 5 years, you are actually building a capital of about 80 lakhs to a crore, and you can just go in the market and buy your flat. So if you do not have the responsibility for you to provide for your family, it will always make sense to go in a mutual fund SIP, build that initial corpus, and then probably you decide about say buying a property or something else based on your goals.
Correct. Yeah, even that's something even I recommend everyone as well. At least get started with 10%,
Hmm.
and then over the period you can increase that amount. And there is also this concept called as FIRE, right? Financial independence, retire early. And I recently read a book where the author recommends in the initial days you live a very frugal life and invest like 50% in the initial stages. Like design your life in a simple way and then keep up to 50% as an investment. and after a few years the compounding effect takes over, and you'll have like a better return in the long run. And of course, yeah, we talked about SIPs now, right? So can you just touch upon like what exactly is an SIP and what is a lump sum investment?
Okay. So, with due respect to the author, again, I would generally prefer somebody to live a balanced life. So, it need not be a frugal life or a very lavish life. It should be balanced. You should enjoy a decent luxury. At the same time, you should invest so that your future years are secure, right? The other part about SIP and lump sum. So basically, SIP is like a monthly recurring deposit, but in mutual funds, wherein you fix a certain, say, 5,000, 10,000, 50,000, that will be debited from your account and gets invested every month, irrespective where the market is, irrespective, what your feeling is on that day. It will just get debited and gets invested into the mutual fund schemes. Whereas in lump sum, it is more like an fixed deposit, wherein you make a bulk investment, right? But again, when you put a bulk investment, then the timing in the market is very crucial, because there is always a scope that, if you put a bulk investment today and from tomorrow market starts correcting,
Hmm.
right? So then you, at a lot of time, you need to understand that, whether you should go for SIP or whether you should put lump sum. Again, schemes may be different for SIP or lump sum, depending on your goal, your risk appetite, and how long you are willing to keep your funds. So in SIP, you could go for a bit aggressive schemes as well, because you want market to fall faster and grow faster, right? Wherein in lump sum, you may not want your capital to erode much, but again provide a decent upside. So the schemes would vary between, both options.
Okay. So basically in SIP, then you give an instruction to the fund saying that on so and so date, debit this much of money from my bank account and invest in so and so fund or so and so scheme. That's the SIP. It doesn't matter what the market is, that amount will get debited no matter what. And in the lump sum, is let's say you get like a any gain or unexpected return of money, and then you take
Hmm.
the entire money as an ad hoc and then invest in some scheme. Is that fair summary?
Correct. Yes.
Okay. Okay. And based on your experience, like there are like thousands of schemes right now.
Hmm.
Based on your experience, how many schemes should one person invest in ideally?
Uh, so we have seen portfolio with as little as 4 or 5 schemes, and we have seen portfolios with as high as 120, 130 schemes.
Oh goodness.
Now, just to tell you, each mutual fund schemes invest in at least, say, 40 to 80 different companies, right? So mutual fund in a way gives you diversification. Even single scheme gives you diversification. Now, if you have 4 or 5 different schemes in your portfolio that complements each other, say for example, you have one scheme that focuses on large cap and mid cap, one scheme focuses on small cap, one scheme focuses on, more of a margin of safety. If you create a balanced portfolio, that gives you a lot of cushion and a lot of comfort in the portfolio that they are going to do well over a period of time. Now, when you look at a portfolio with say 100 or 70 or 30 or 50 schemes, then what happens is that you are not able to track each and individual schemes, that how they are performing, what sort of portfolios they have created, whether, if market falls tomorrow, how your fund is going to perform. So the tracking becomes a lot of challenge when you have more number of schemes. And at the same time, when you already have a diversification, correct, you want to own a reasonable number of stocks in the portfolio. You do not want to own the entire universe,
Correct.
right? So when you have say 80, 90 different schemes, or even for that matter 25 different schemes, right, in a way you are going to own about 500 stocks.
Hmm.
So again, you do not want to do that. For wealth creation, you need a bit concentration as well, but spread across probably 4, 5, 6, 7 different schemes, that is more than sufficient.
Okay. So 4 to 7 schemes is what you recommended.
Yes.
Okay. Now what are some of the common fees or expenses that are associated with the mutual funds?
So typically there is an expense ratio which is charged by mutual fund companies that could range anywhere between say 0.5 to 2% or 2.5% depending on the market you know overall AUM that they manage. So now SEBI has regulated the expense ratio that companies can charge for the scheme. So as and when the AUM grows, your expense ratio comes down, right? Again, it is not something that directly matters for your fund performance, because for fund performance the expertise of fund manager is very crucial. The strategy put in place by the fund management team is very crucial. So I have seen funds with say reasonably decent expense ratio perform very well over a period of time. So it is not that the lowest expense ratio will wins the race over a long period of time. It is a well-defined strategy and well-defined fund management team would do well over a period of time.
Okay, so one is the expense ratio that the mutual fund charges. What else?
Hmm.
Are there any other expenses?
So, for example, if you withdraw your funds before a year, most of the equity schemes charge an exit load. So
Mhm.
that basically encourages you to stay invested for long term. So yeah, that is one expense if a person withdraws within a year.
So this expense ratio that you're talking about, is it charged one time or is it charged every year or every month?
So that is a annual expense ratio, but amortized every month. So, say for example, 2% is the expense ratio, then it is amortized every month and charged to the scheme. And whatever expenses the mutual fund company has to incur, that comes from that expense ratio.
Okay, so that's the expense ratio. So 1% or 0.5% to 2% is the expense
Yes.
ratio, and there could be an exit load if somebody is withdrawing before 1 year.
Yes.
Okay, so that's the expenses. And now let's talk about some. At least we don't have to go deep into taxation, but what are
Hmm.
some of the tax implications that the beginner investor should keep in mind?
So basically, mutual fund taxation nowadays has been simplified post the budget. So, for example, any mutual fund scheme which is equity oriented. So, equity oriented is where 65% or more is into equity or stocks. That is taxed, say long term, that is taxed at 12.5%. If you withdraw within a year, that is taxed at 20%, right? For example, if it debt oriented, wherein 65% or more is into fixed income securities, then it is charged on the slab rate.
Okay.
So, irrespective whether it is long term or short term, it is charged on the slab rate. And if it is allocation is between these two,
Okay.
right, then you say if it is long term, that is if you hold it for more than 2 years, then the long term gain is 12.5%. And if it is short term, then you have to pay by the slab rate.
Okay. Makes sense. And how often should the investors review their portfolio?
Typically, one should look at the portfolio at least once a year.
Okay.
So, how generally, a person should look at the portfolio is once a year when they review it, they should identify the schemes if they are not performing well and put that on radar and review those only schemes, say maybe closely in say 1 quarter or once in a half year. And you see that whether the funds have taken corrective approach, whether anything has changed in the portfolio, whether fund management team has changed any strategy. So once you do that, you will be able to decide whether you want to retain that scheme or whether you want to get out of that scheme or whether you want to even invest more into that scheme. So once a year is good enough. If you have something you are satisfied with the return, you put it on autopilot, it keeps growing. But when you identify schemes that are not performing well, probably you need to look closer and you need to say review it every quarter.
Okay. And now let's say if a particular scheme is not performing to my expectation, when to sell? Like what do you recommend? When to sell?
So when you identify that this scheme is not doing well, right? then you want to look at it, that why it is not doing well, whether some things have changed, right? Say for example, you did all your research prior to investing, you identified the scheme, you invested, but then something changes, like for example fund manager changes or the strategy changes. So whether it is overall market that has not performed well, or whether the scheme has not performed well, first you need to make the decision. Second is what, whether fund management team has changed anything in the particular scheme. So that is your second call. And third one, if there are any issues with the particular scheme, why if they are not doing well. For example, the fund has seen a lot of redemptions in the recent past. Then why it has happened? Based on that, you can take a call whether you need an immediate action of redeeming the mutual funds, or maybe you want to give it another 2 to 3 quarters to see if the fund revives their performance or not. Because see, market is cyclical, so not all fund managers will perform at the same time. So you want to give ample room to your funds to perform, but at the same time, you also want to keep a close eye whether they are able to catch up, or whether it is something in a perpetually laggard category. So a lot of time, what happens is that particular fund gets in the top rank, in particular year, but falls down the grace, over a period of next 3 to 4 years. So you don't want to get end up in that scenario. So that is why you need to evaluate, on a quarterly basis.
And what are the best resources or tools to research about schemes and mutual funds?
So now there are a lot of online platforms which are available. Value Research for one is one platform. Then Money Control is there. So a lot of platforms are available that you can go on and research about the funds. Now, when you want to make a qualitative decision about a particular scheme, listen to that fund manager when they're coming on TV, or whether they have a video on YouTube, and understand about the investment philosophy, whether they are risk takers or risk averse, whether they follow growth investing or they follow more of a conservative approach, and then you decide whether that aligns with your objective or not. Because if you are a risk taker and you invest in some schemes which is conservative, it will never satisfy your expectations over a long period of time. So
Okay,
always try and map out that what are your expectation, what is your behavior vis-a-vis what the fund or the scheme does.
makes sense. And again, if somebody who is just starting out, they are new into mutual fund investing. What are some of
Hmm.
the mistakes that they should avoid?
So they rely solely on past performance. That is the number one mistake, and they should avoid it, because the top performing scheme may not remain on top. Second thing, maybe underplaying their risk capacity. So at times they feel like, okay, I'm a risk taker, but in a way, when they see their portfolio down by 20%, they panic. So truly judging that what is your risk capacity.
Okay.
So if a person, just to give you an example, if a person has invested only in fixed deposit over a 10-year period or 12-year period, right? And they suddenly come in the small cap category saying that now I'm a risk taker. So that generally does not work well. You need to understand that why you were in fixed deposit for 10, 12 years. If you had that mindset of earning fixed return for long period of time, then it is not just on and off switch that you from tomorrow you become risk taker. So you need to understand that. Third thing is, have a reasonable expectation from the market that maybe 30, 40, 50% return every year may not be, it's probably not possible.
Okay.
So you need to be ready with say 15, 20% kind of return, at times with negative returns, at times, return between 10, 12% as well. And again, do not give a very short period of time to your investment. You rather give a bit long period of time so that your investment can grow. Because market goes through a lot of cycles. If you see your portfolio going down tomorrow, it may go up, the day next after. So you need to give ample time to your investment. Don't micromanage.
Okay. And one of the common mistakes that I have seen with some of my close network is they get excited, invest in a scheme, then if the returns are not as their expectation, and they just withdraw it.
Correct, correct, correct. And that is probably, nowadays that case is on the rise because a lot of this platform which are available, they publicize that this is the best performing scheme. See, performance has come in the past, right? You look at a particular scheme with a performance of say 70, 80, 100%, even 120% over 1 year period, and you get excited. Okay, this is the best performing scheme. But that performance has already happened. Now, what gives you that guarantee that that performance is going to repeat over next 2 year period or 5 year period?
Correct.
Correct. So one is a systematic investment wherein you take a balanced view. One is more of a probability based approach wherein you believe that certain segment can do well over a period of next 2 to 3 years, and you make a small portion of your portfolio into that scheme just to take that extra return.
Correct.
So you need to have a good understanding about how the schemes work and what are you expecting from that particular scheme.
True.
Do not expect moon from the scheme and fall on the earth.
I think one of the recently I met someone who gave like who was just casually told that if you invest in fixed deposit, it's like you get fixed return.
Hmm.
But the most people don't invest in stock market because they feel it's risky. It's actually not risky, but it's actually volatility. So sometimes you may get more than FD, sometimes you may get less than FD's return. But what he said was if you invest for let's say 5 to 7 years in one scheme or one stock, the chances of your risk goes down to almost zero. It doesn't mean that you get the high return, but it's just that you won't get a loss. It could be one
So
percent to 2%.
generally, correct, correct, correct. So it is said risk in life is not taking any risk,
Huh.
right? The biggest risk for life is not taking any risk, and inflation is the biggest risk for a person. So when you create wealth, your purpose is to not run out of money when you become 60, 70, 80 years old.
So now, like based on your experience, like can you share few tips for new investors so that they can maximize their returns?
So basically, start with particular amount that you want to invest. Preferably, if you're a first time investor, monthly investment would make a lot of sense because it eliminates risk. If market goes down, you still continues to invest, and that helps you cost of averaging, uh, benefit of averaging. Second option would be to have a bit longer term horizon. Keep at least 5 years or 7 years for your investment. And third option would be seek out help from people who have spent time in the market, that they will help you understand how market works, how it behaves.
Okay. And what are the best books that you recommend, or who can we follow on social media or this thing to learn?
So instead of books, you should rather learn from fund managers. There are a lot of speech available on YouTube wherein you can get to listen, say, Nilesh Shah or maybe Prashant Khemka or Sunil Singhania. They are legends in the market. They are more like an encyclopedia of information about economy, how companies work. So when you listen to them, they have decades and decades of experience and experience of managing wealth. So they will probably give you the insights about the market, how it performs, what sort of expectation you should rather keep, what are the risks involved in investing in the markets, and how basically that helps creating wealth. Because see, ultimately we all have to agree on is India is a growing economy. India has done extremely well over past 1 decade, and there are still 2 decades for India to grow at a very faster pace. So generally, when you research about economies that have done well in the past, more or less it has indirectly linked to the median age of your population, right? So for example, the country like China, 10 years 15 years back, they had a median age of about 26, 28. Today, their median age is about 38. So in last 15 years, we have seen that China actually became a world leader in terms of production. Right. So similarly, if we look at India's median age today, that is in the range of 27, 28. So we have a glorious 10, 20 years ahead, wherein there would be a lot of consumption driven, growth in the market. So when you are looking to invest in India, there are a lot of companies that are already listed which will dominate the space. There will be a lot of new, companies that would get listed over a period of time. New brands will come, and that will give you enormous opportunity to make wealth.
Got it. So your recommendation, instead of books, follow fund managers like Nilesh and other experts.
Yes.
I have a recommendation for this thing because I read a lot of books. That's my expectation.
Right. I know you read about what, 1,000 books?
No, no, 3,000 books.
3,000. Wow.
Yeah. So, on in terms of investments, personal finance, in the Indian context, I recommend these two books: Let's Talk Money and Let's Talk Mutual Funds. Both of them written by Monica Hallam. Like it's
Okay.
very good for beginners.
Okay.
So that's two recommendations that I have for books.
Hmm.
And you have worked with like hundreds of clients, right? I'm sure you get asked thousands of questions. Some of them
Hmm.
are very basic, some of them are stupid, and some of them are very intellectual.
Hmm.
Out of all those questions that you get asked by your clients, what are some of the questions you wish they asked you but they don't ask generally?
Um, so one question is, where what wish they would generally ask is, how this funds, you know, will generate so and so returns over next 3 to 5 years. Because if they ask that, there is a scope that they want to understand about how mutual fund and how portfolio works. So generally, what question we are generally asked is, Acha, what performance it will give.
Correct.
So instead of that, we need to focus on, okay, how the portfolio is created, what sort of opportunities we are trying to capture. Because see, percentage and everything is just an estimation that okay, next 3 years this is the estimate that we could get. But if we understand the thesis right, there is a potential for wealth creation at a much better way. So yeah, that is one thing we expect, or we wish rather, that people should focus more on understanding where they're investing rather than what returns they could expect.
Yeah, it's a very good way of looking at it. True. So the final question of the episode: can you give one or two action steps that my audience can take in, let's say, next 24 hours that will help them to get started with mutual funds?
So first thing, always ask yourself this question before investing or before even looking at any investment option is whether you want to create wealth or whether you want to preserve wealth. Because once you answer that question, a lot of follow through questions will get sorted out. So if you are in wealth creation stage, you should focus on which are the sectors or which are the ways that would give you maximum returns, right? If you are in a wealth preservation stage, you need to focus on having a balanced growth, but you want to protect your capital, right? So that is one. Second thing, uh, always see that how many years you have to invest.
Hmm?
So if you have say 15, 20 years, always look to invest for at least 10-year period,
Okay.
right? Because that is when you would rather create that wealth, but always look at in the incremental way. So do not just go on the Google, download the calculator that by 30 years you will create so and so wealth, because priorities change. So rather live with your money, but again invest the same money as well.
Okay. So if you have to break it down into like a specific action step, what would that be?
So first define, okay, what wealth creation or wealth preservation.
Yes.
Second thing, you determine that, okay, write down the percentage return that you realistically expect from the mutual funds or any investment rather. Okay. Second, third point, Write down the tenure, that by when would you want this money back.
Nice.
When you write down these three steps, then you look at the options that you have at your disposal, and yeah, you're good to go.
Yeah, so that's the action step for you guys. Make a decision like this is the amount that I want to invest right away, and then decide the tenure. And maybe you can either invest yourself, or you can talk to some RIA, or you can reach out to mutual fund distributor like Tejas and get started with your investment journey. And again, one recommendation or one tip that I have for you is initially it might seem that the returns are very less, like 5%, 10%. But if you keep it for like 5 to 7 years or even 10 years, the compounding effect will kick in. The return will look something like this. So that's the action step for you. Go and take it. And finally, if someone wants to reach out to you, Tejas, what's the best way to reach out to you?
So I'm there on social media, Instagram, Facebook. We have a website which is fincareservices.com. There is a mobile number mentioned, which is 977 368 7483. So I'm available to discuss your queries. If you want to even understand about how mutual fund works or how economy works or what sort of benefit we are looking at, I'm looking for discussion.
Perfect then. Thank you.
All right. Thanks.
Thank
Thanks, Srini. Nice talking to you.
Nice, man. Nice talking to you.